What if you could press the reset button on your financial life? No portfolio, no investments, just you and a fresh start in 2026. Would you do things differently? I've been investing for 8 years now, and I've learned some hard lessons along the way. Made mistakes that cost me money, time, and a lot of sleep. But here's the thing. If I had to start completely from scratch today, I'd do it very differently. In this video, I'm going to show you the exact roadmap I'd follow. Not theory, not textbook stuff. The real practical steps that actually work. By the end of this video, you'll have a clear plan to build real wealth starting right now. Let's dive in. Chapter 1. The Foundation. Get your financial house in order. Here's a reality check that might sting a little. Nearly 40% of people can't cover a $400 emergency without going into debt. Think about that for a second. $400. That's a car repair, a broken laptop, a surprise medical bill. Now imagine you're one of those people and you've just started investing. The market's doing great, your portfolio is growing, and then boom, your car breaks down. You have no emergency fund, so what do? You pull money out of your investments at the worst possible time, maybe even at a loss. This is how most people fail at investing before they even get started. When I first began investing, I made this exact mistake. I was so eager to catch up with everyone else, watching people going on luxury vacations, hearing friends talk about their wins, that I started throwing every dollar I had into the stock market. Money from my paycheck, money from my savings, money I honestly couldn't afford to lose. And guess what happened? The market dipped. I panicked, sold too early, and ended up worse off than when I started. So if I'm starting fresh in 2026, here's what I'm doing first, before I even open an investment account. Step 1. Clear high-interest debt. If you've got credit card debt, store cards, or personal loans with interest rates between 20 to 40%, you need to tackle those first. Here's why. The stock market historically returns about 8 to 10% annually. But if you're paying 30% interest on debt, you're losing money faster than you can make it. It's like trying to fill a bucket with a massive hole in the bottom. Step 2. Build an emergency fund. I'm talking 3 to 6 months of essential expenses in a high-yield savings account. I know, you want to start investing now. But trust me, this emergency fund is what lets you sleep at night. It's what keeps you from panic selling when life throws you a curveball. Step 3. Stabilize your income and spending. Figure out exactly how much you can invest each month without stressing yourself out, because when your basics are covered, you can actually ride out market dips without freaking out. Don't see this as delaying your investing journey. See it as level 1 of your wealth building plan. Because once your foundation is solid, you'll invest with confidence and actually stay invested long enough to see real results. Chapter 2. Know your why, define your goals. Less than a third of investors actually have specific long-term goals when they start investing. Most people just think, investing is smart, I should do it. So they download an app, pick some random funds, maybe buy a trending stock they saw on social media, and hope for the best. Then the market drops 10%, or they hear rumors of a crash on the news and they sell. Just like that. If I'm starting over, the very first question I'm asking myself is, what am I actually investing for? Am I trying to retire early, buy a dream home, travel the world, build generational wealth? Because your goals dictate everything. The account you use, the risk you take, how you handle the ups and downs. Here's my simple framework. Short-term goals. Less than 5 years. Keep it in cash. Saving for a house deposit, a wedding. Keep that money liquid and safe. Investments can be bumpy in the short term. Long-term goals, 5+ years. Invest it. The longer your timeline, the more those short-term fluctuations smooth out and the better your chances of building serious wealth. Let me show you real numbers. Between April 2020 and April 2025, $2,666 invested in global shares grew to $4,926. That same amount in cash only grew to $1,714. That's the power of long-term investing, and that's why knowing your timeline matters so much. quick pause. If you want to lock in your financial fresh start, smash that like button right now and subscribe so you don't miss the blueprint. Okay, back to the video. Chapter 3. The account that changes everything. This is where most people get stuck. Analysis paralysis kicks in hard. You start researching investment accounts, then you research another one, and another. Hours of scrolling, dozens of tabs open, and you still haven't actually opened anything. I get it. Investing seems complicated from the outside. Like you need a finance degree just to get started. But here's the truth. Once you've got your foundation and you're clear on your goals, the next step is shockingly simple. Open an investment account. Put money in it. That's it. You can literally do this from your phone in about 10 minutes. You're now 90% of the way to being an investor. So which account do I choose? If I'm employed, I max out my workplace pension match first. Free money from my employer plus tax advantages? Absolutely yes. The downside is I can't touch it until retirement, but that match is too good to pass up. If I'm self-employed, I open a private retirement account to get those same tax benefits without the employer match. Then I open a tax-advantaged account. In the UK, that's a stocks and shares ISA. In Canada, it's a TFSA. Wherever you are, check if your country has a version of this. Why? Because all your investment growth stays yours. No tax on dividends, interest, or profits. Over decades, this makes a massive difference. Chapter 4. Start small, but never stop. Here's something that blows people's minds every time. If you invest just $100 a month with an average 8 to 10% annual return, after 30 years, you'll have over $140,000, and you'll have only put in $36,000 yourself. The rest? Pure profit from compound interest. That's your money earning returns, and then those returns earning their own returns, creating this snowball effect that gets faster and faster without you doing anything. But here's the problem. Most people never get that far. 44% of people say lack of knowledge stops them from investing. 41% say they're scared of losing money. If that's you, I totally understand. The stock market can feel intimidating. But here's what I'd tell my younger self. Start small and be consistent. If you follow the rest of this plan, you're very unlikely to lose money over the long run. Which brings me to the next crucial step. Chapter 5. Don't put all your eggs in one basket. Imagine your New Year's resolution is to eat healthier. You wouldn't fill your plate with only pasta or only salad or nothing but protein. You'd mix it up so you're satisfied, energized, and getting all the nutrients you need. Investing works the same way. If your entire portfolio is just tech stocks or just crypto, it might look exciting. But when that sector takes a hit, your whole financial future takes a hit. That's where diversification comes in. If I'm starting from scratch today, I'm keeping this dead simple. I'm investing in index funds. An index fund is just a collection of investments that tracks an entire market, like the S&P 500, which includes the 500 biggest US companies. Instead of trying to pick the next Amazon or Apple, I'm automatically invested in all of them at once. With one simple investment, I get exposure to hundreds or thousands of companies across technology, healthcare, finance, energy, and more. The winners offset the losers. Over time, that balance helps you grow steadily without lying awake at night worrying about losing everything. Chapter 6. Set it and forget it. Want to know the secret to great investing? Doing nothing. Fidelity once discovered that their best performing investors were people who had either forgotten they had an account or had passed away. I'm not making this up. The people who checked their portfolios the least made the most money. I'm not saying you should literally forget about your investments, but it proves that the less you tinker, the better you usually do. If I'm starting fresh, I'm automating everything. Here's what that looks like. Set up a monthly automatic transfer from your bank to your investment account right after payday, before you have a chance to spend it on anything else. This does two powerful things. First, it makes investing consistent. You're not relying on willpower, it just happens. Second, it protects you from your emotions. When markets drop, you don't have to decide whether to keep investing. The system does it for you. No more "is now a good time to buy?" No more "maybe I should wait until after the election." You just invest automatically, get on with your life, and let your portfolio grow in the background. Simplicity wins in the long run. The goal isn't to outsmart the market, it's to build a system that keeps you investing no matter what the market is doing. Chapter 7. When everything falls apart. The stock market has crashed 19 times over the past 150 years, and every single time it recovered and reached new highs. But when it happens to you, it never feels like that. You're not thinking about the bigger picture. You're watching your balance drop and wondering if you've just made a huge mistake. Look at this chart. It shows over a century of stock market history: the Great Depression, the dot-com bubble, the 2008 financial crisis, the COVID crash. Some of these wiped out more than half the market's value. But here's what's incredible. After each crash, the market bounced back higher than ever. The COVID crash recovered in just 4 months, the fastest recovery in history. The 2021 downturn took 18 months. Even the Great Depression, the worst crash ever recorded, eventually recovered. When I first started investing, I panicked every time the market dropped. I thought I'd made a huge mistake. But what I learned is this: the market rewards patience, not panic. And this is exactly why everything we talked about matters. Your emergency fund gives you the freedom to not panic sell. Your clear goals keep you focused on the long term. Your automated system keeps you investing even when it feels scary. Conclusion: your fresh start begins now. So if I'm starting from scratch in 2026, this is exactly what I'd do. Get my financial foundation solid. Define my goals. Pick the right account. Start small but stay consistent. Diversify with index funds. Automate everything. And learn to stay calm when things get messy. You don't need a 6-figure salary to do this. You don't need a finance degree. You just need to start and stay the course. You'll probably make some mistakes along the way. I did. But as long as you stay invested, keep learning, and focus on the long term, those mistakes won't define your results. If this helped you, make sure you're subscribed because we've got more coming on building your perfect investment strategy. And if you know someone who's been thinking about investing, share this with them. Your future self will thank you for starting today.